Hello again, everybody. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, May 5th, 2024. Today I'll be talking about what Asbury Research's latest data-driven market research and quantitative models are saying about current financial market conditions. That is, when to be on offense and looking for opportunities to add to your portfolio, and when to be playing defense and protecting your capital. After studying the financial markets for over 40 years, I have learned that, contrary to what a lot of financial professional people may be saying, you can most definitely time the markets. There are times when it's a lot harder to time the markets than others, but it can be done consistently with an unemotional, data-driven, and repeatable approach that just follows the money rather than trying to forecast the future. Asbury Research has been providing both investment research services and money management to individual and professional investors since 2005. For more information about us, visit asburyresearch.com and use the contact tab, which is right here on our screen up in the corner, or just click the link in the description of this video. Finally, if these videos are useful to you and you'd like to see more of them, please like and subscribe. Now let's follow the money by identifying some key areas of our focus over the next several weeks or more. Let's begin with our Asbury Research tactical models by looking at the Asbury 6. So we're going to go into the Research Center here. If you're a subscriber, you have your own login, so you can get in here 24/7, and you can see up at the top is where all of our models are. We have the Asbury 6 here. We have the CPM, the correction protection model. We have our CEF model. Both CPM and CEF are options for our money management service. We have our two relative performance models, the CART model and the US versus the world model. And then we have our sector and industry group ideas, which are individual trading ideas via ETFs. And then finally, our models monitor, which puts all of our open ideas into one place for easy access. So let's begin here by going into the Asbury 6. And what we see is 4 of the 6 are green or positive. And you can see that 3 of these, the rate of change in the S&P 500, trading volume in the S&P 500, and market breadth in the NYSE, are all green as of the end of last week. This positive change in the Asbury 6 directly relates to last Wednesday's dovish commentary by Fed Chairman Jerome Powell, and then it was followed by Friday's Goldilocks jobs report. By Goldilocks, we mean it was not too hot, it was not too cold. It showed that hiring slowed sharply in April and wage growth eased, but without signaling a serious deterioration in the job market. Stocks rose and interest rates declined. If you were watching the yield of the 10-year, you saw the yield of the 10-year had been hovering about 470 for weeks. As soon as the jobs report hit, yields started to fall. They fell pretty hard. They fell almost 20 basis points by the end of the day on Friday because the market interpreted all of this as giving the U.S. broad markets larger 2023 a little more room to run before they have to start worrying about a rise in interest rates. For those unfamiliar with us, the Asbury 6 was created to provide a data-driven daily indication of the true internal health of the stock market. 4 or more constituent metrics in the same direction indicate a directional bias for the market. So you can see that here. We have 4 here, 4 green, which turns the model to bullish or positive. The purpose is to help to prevent us from making trading and investment mistakes due to all the day-to-day volatility in the marketplace that has, at times, I think has forced all of us, including myself, that's been doing this for a long time, to make emotionally driven trading mistakes. Getting scared out of a good idea to buy because the market has a couple of bad days, and then 3 days later, you have to buy back into the market at a much higher price. The A6 is trying to keep us focused on what the real internal health of the market is rather than chasing the tail of the S&P 500. The Asbury 6 is updated every day, about 2 hours after the close. It is available via the Research Center. As long as 4 or more of these stay green, it tells us the internal health of the market is good, and we should continue to see higher prices on a tactical basis. More information about the Asbury 6 and the CPM and the CEF model are all available. We're not going to do that here today, but if you go to models, click models and scroll down, you'll see a lot more detailed information about all of those, kind of teach you how they work and what they do. The next thing we want to look at today is some of the key levels in the stock market via last Thursday's Keys to This Week report, which is one of the regular reports in the Asbury Research subscription service. So we're going to go back up to Research Center and we are going to scroll down. You can see all of our individual reports here. We're going to scroll down to Keys to This Week. You can see this is from Thursday, May the 2nd. And what we're going to do is scroll down to chart number 1. Chart number 1 is very important within the context of what happened in the economy last week, what happened just in economic news with jobs and with Powell and with the A6. So jobs and Powell affected the A6. That's why it turned back to green. Were there other reasons? I'm sure there were, but this was the catalyst, and we saw it in the internals now, so we know it's real. What we want to also see is that it is having a positive effect on price. So that's kind of the third, the third leg of the stool, so to speak. So here we're looking at the S&P 500. Again, this is back from a couple of days ago, but this shows that the S&P 500 is in the midst of a correction, and the correction is going to remain intact from a price standpoint as long as we stay above 51.29 to 51.46. SPX closed right in the middle of that area on Friday. We need to get above there in order to confirm that what we're seeing in the Asbury 60 improved internals is enough to actually change the direction of price. This is the convergence of the 50-day moving average here in blue, the minor low that we made on April 4th, and also the 50 and 61.8% retracements of the move down from the March 28th peak. So that's something that we're going to be focusing on to make sure that the market is reflecting what we're seeing in the A6. Next, let's talk about sector rotation. And sector rotation on our website is available right here by looking at the CEF model, clicking on the CEF model. Sector rotation is really important to us because it shows which parts of the market are outperforming the S&P 500 and which parts are underperforming. You can tell what the market thinks by looking to see what sectors it's buying and what sectors it's selling. Our CEF model is a data-driven sector rotation model. I built the first version of this probably about 7 years ago. It measures the investor asset flows moving around the 11 sector spiders in 3 different time frames. There is still a lot of jumpiness and indecision in the market this year, which can be seen in a lot of erratic sector rotation via the CEF model. In addition, we're also seeing something we haven't seen in a long time. We're seeing non-US equities and also emerging markets starting to outperform again, outperforming the S&P 500, especially for EM. We haven't seen that in a long time. This could be an indication by the rest of the world that are starting to become apprehensive about just how much higher the S&P 500 can go, just how much longer it could lead the rest of the world. In our previous Follow the Money podcast with you on April the 21st, 2 weeks ago, we said that energy and industrials remained on a CEF model favored ranking. The CEF model has since profitably exited that long overweight signal in energy, but still maintains the previous signal in industrials. Why? Because the money is starting to leave the energy sector, but continues to flow into industrials. We're just interested in following the money, not forecasting what may happen in the future, but going where the money goes. At the other end of the spectrum, by the way, investor assets are the most aggressively leading consumer staples. Let's take a look at the industrial sector via our rainbow charts, which are the accompaniment to the CEF model. So we're changing our view here, and we're looking at the rainbow chart for the industrials. So it's called the rainbow charts for obvious reasons. This shows the daily ranking in the SEAF model going back for one full year, and you can see how it kind of oscillates back and forth between avoid, which is red, neutral, which is yellow, and favored, which is green. Down here is the corresponding relative performance chart of industrials versus the S&P 500, or in this case, XLI versus SPY. So what we want to point out for you today is since, let's say, since middle of March, right in here, we got back out of neutral territory and back to a favored status, and with a little jumping around, have stayed in favored status. This is why SEAF continues to be, this is why industrials continue to be favored by SEAF. In the meantime, look what's going on in the relative performance chart. It's moving higher. What does that mean? It means there's money most aggressively moving into the industrial sector in three different time periods, according to SEAF, which is driving the relative performance. It's been outperforming during this period. So this is a way of connecting what we see in the SEAF model itself to what is really happening. And it shows the relationship between asset flows and relative performance. So again, industrials is still one of the three favored sectors according to SEAF, and the other two are available by going into the research center and going into SEAF. Finally, let's look at two more charts from last week's Keys to This Week report for the US stock market. And we're going to move back to the research center, and we're going to scroll down to Keys to This Week again. And Keys to This Week, top 10 charts and data series. It's produced every week that we think are the most important to focus on, are going to have the most influence on the stock market right now. So our last two that we're going to look at today are a little more strategic in nature, a little bit more farther looking in nature. The first one has to do with relative performance. So we're going to scroll down a little bit further on the page. So this is key number 7 this week, and this is the relative performance of stocks versus bonds via SPY versus the iShares Core US Aggregate Bond ETF, or AGG. Let's make it bigger. So what we see here is S&P 500 up top, going back to October of last year, and then we've got the SPY versus AG, the relative performance chart down here on the bottom, along with the 63-day moving average. Why 63? Because this is not a tactical tool for us. If it's tactical for us, we're looking at it through a 21-day lens. For strategic, we're looking for a 63-day lens, which is one business quarter, 63 days. And what we see is that SPY started outperforming AG on a 63-day basis on November the 3rd and continued to outperform while the S&P 500 moves steadily higher. When stocks are outperforming bonds, historically, the stock market likes that. It's a sign of internal strength, and the stock market goes higher. But look what's happened here over the past few weeks. It's come down. The relative performance chart came and tested its 63-day moving average, its quarterly moving average on April 19th. Had a little rebound, which was this little rebound that we had off the April 19th low in the S&P 500, and now we're testing it again. This tells me from a longer term basis, we know the tactical is getting better because the A6 has turned back to green, but this is strategic. This is longer looking. If the bull market in the S&P 500 is still intact from a longer term perspective, quarterly perspective, then this relative performance trend should stay intact. If it does not, and it rolls over and we start underperforming, that's going to be a sign to me that strategically the market is getting tired. It's starting to roll over. So again, not something that we're going to pull the trigger on in terms of a trade, but it tells us the overall environment that we're dealing with as we go into the summer months. Finally, the last one is also strategic in nature and has to do with investor sentiment. by looking at the Investors Intelligent percent bears series, which we see here. Actually, Asbury Research is one of the inputs into the II data. It's very important to us. We like to know what the market's thinking, and we do that by looking at investor sentiment. So this is showing that the percentage of bears for firms like ours that are investment advisors is very low. Only 14 to 16% are bears as of April the 12th. And you can see, if we go back across the chart, you can see the red verticals here point out other periods where this least bearish extreme had been met. And every one of these is right before we had some kind of a significant peak. This goes all the way back to 2010. So is this a signal to sell? No. But it is a signal to let us know that the market is starting to get a little too happy. It's getting a little bit too unworried about having a bearish reversal, and that's when historically bad things happen. It could happen a month from now. It could happen 2 months from now, as you can see by this longer term chart. But what this tells me is my expectations for what happens from where we are right now in the S&P 500 are a little tempered. This chart tells me the likelihood of us having another one to several quarter move here from now to the end of the year is very unlikely, because historically the market is set up. It's set up to move into more of a significant peak than it is to have an extended move higher from here. So finally, for those who like to follow us in the media, we are my next interview is going to be Wednesday, May 15th at 9 o'clock in the morning, Chicago time, 10 o'clock Eastern. I'll be interviewed by Oliver Rennick, who's the lead anchor of the Schwab Network. Oliver and I will be breaking down the latest signal from the Asbury 6 and other Asbury Research data-driven models, and all the videos from all of our recent media appearances are available right here at Asbury in the media. So you can click here and you could learn a little bit more about our approach to investing. So that wraps up another Asbury Research Following the Money podcast for this week. Our next Following the Money podcast is tentatively scheduled for Sunday, May the 19th. Hope to see you here again soon. Please don't forget to like and subscribe. Thanks for watching.